All right, let's dive right into this explainer and run Prestige Consumer Healthcare, ticker symbol PBH, through the ultimate fundamental investment gauntlet. Welcome, everyone. Today, we're looking at a company whose products are probably sitting in your medicine cabinet right this second. We're talking about the makers of Monistat, Clear Eyes, Summer's Eve, Compound W, the whole shebang. But despite owning these household staples, PBH stock has been on an absolute roller coaster lately, mostly going down. So, as fundamental investors, when we see a massive drop in a consumer staple like this, we've got to ask, is the market severely mispricing a hidden gem? Or is this a classic value trap just waiting to snap shut?
So here is the gauntlet we're running today. 1. The PBH setup. 2. The quantitative crunch. 3. The Oracle's lens. 4. The Lynch test. And finally, 5. The final verdict.
Section 1. The PBH setup. The scene of the crash.
First up, we need to understand the crime scene here. Because this company makes products that sit in almost every medicine cabinet, yet we are looking at a staggering number, negative 44.52%. That literally represents the drop in PBH's market cap over the past year, dragging the stock down to around $47.53 based on recent data. I mean, almost half of the company's valuation was wiped out in just 12 months. For a company selling boring, essential, over-the-counter health products, that kind of volatility is a massive red flag. It absolutely demands our attention.
So, what exactly caused the floor to fall out? Well, the sell-off was triggered by a perfect storm. In Q4 of fiscal year 2026, revenue dropped by about 4% to $281.6 million. And on top of that, we saw some serious margin slippage. Their trailing net profit margin dropped from 18.9% down to 17.5%. A huge chunk of this pain was driven by severe supply chain constraints that just crippled their ability to meet the demand for Clear Eyes. Ultimately, management missed their own adjusted earnings per share guidance, hitting $4.38 instead of the projected $4.54. And, whenever that happens, the lawyers start circling. Sue Wall Street actually launched a shareholder investigation into possible securities law violations regarding those missed projections. It's really just a textbook cascade of bad news.
Section 2. The quantitative crunch. Running the 5 valuation models.
But hey, does a bad year automatically mean a bad business? Or is this a rare buying opportunity created by a market overreaction? Let's start with our first valuation model, the price-to-earnings ratio. And here we see some immediate quantitative appeal. The stock is trading at a steep discount of just 10.7 times forward earnings. When you compare that to its own 5-year historical average of 14.44 and the broader U.S. pharmaceuticals industry average of 15.3, PBH looks incredibly cheap. The market is basically assigning a much lower multiple to its earnings than it does for its peers.
Moving on to model number 2, the price-to-book ratio. Right now, PBOH has a current P/B of 1.21. That means the market is valuing the company at just 1.21 times its actual book value. Compared to its 5-year historical average of 1.93, PBOH is trading roughly 37% below its historical norm. That is another massive signal of undervaluation.
Okay, model number 3. The absolutely crucial point here is cash generation, and PHBH boasts an 11.12% forward free cash flow yield. To put that into perspective, this means that for every dollar of the company's market cap, they generate over 11 cents in free cash flow. In the fundamental investing world, finding a double-digit free cash flow yield is kind of like finding the holy grail of a cheap cash cow business. Now for model number 4, the granddaddy of them all, the discounted cash flow, or DCF model. This is where we project future free cash flows and discount them back to their present value using the weighted average cost of capital. Simply, Wall Street calculates an intrinsic fair value of $164.53 per share based on their DCF. Against the current $47.53 price? Wow, the numbers suggest a massive margin of safety, with the intrinsic value sitting far, far above where the stock is actually trading today.
Bringing all our 5 models together and actually adding in our 5th metric here, the price-to-sales ratio, where PBH trades at a massive discount of 1.65 versus an industry average of over 22, the quantitative verdict is a unanimous undervalued. Literally every single math-based metric screams that this stock is a bargain. But as you and I both know, numbers in a spreadsheet don't tell the whole story of a living, breathing business.
Section 3. The Oracle's lens. Warren Buffett's investment checklist.
Now we've got to put the calculators aside for a second and look at this business through Warren Buffett's eyes. Going through his legendary checklist, PBH easily passes the understandable business test. I mean, they make over-the-counter pharmacy products, right? Super simple. Do they have a durable brand moat? Absolutely.
People deeply trust brands like Monistat and Summer's. But what about consistent earnings and a high return on equity? Well, PBH's ROE is respectable, sure, but the earnings consistency is definitely mixed lately due to that recent guidance miss and margin slip we talked about. Finally, they are highly shareholder-oriented, aggressively repurchasing 2.3 million shares in just the first 9 months of the fiscal year. And as we saw with the DCF, they definitely have Buffett's required margin of safety.
But here is the giant elephant in the room, and it's a major Buffett fail. PBH holds $1 billion in net debt, leaving them highly leveraged with a 2.6x covenant-defined leverage ratio. Buffett famously insists on low debt, specifically companies that can pay off all long-term debt with 3 to 4 years of net earnings. With their trailing net income easing back to around $190 million, it would take them over 5 years of every single penny of profit just to clear that billion-dollar debt pile. That violates a strict core Buffett principle.
Section 4. The Lynch Test. Peter Lynch's Investment Checklist.
Next up, we focus heavily on categorization and balance sheet health relative to operations. Peter Lynch would classify PBH as a slow grower or a stalwart. These are large, established companies offering boring but essential products. Think about it. Wart removers, enemas, diaper rash ointment, not exactly dinner table conversation, right? But these are what Lynch called perfect stock attributes. They're incredibly boring, they're not in some flashy tech sector, but they generate consistent, recurring consumer demand regardless of what the broader economy is doing.
So, grading PBH on the Lynch scorecard. While it checks the boxes for a boring, understandable business, it hits some serious roadblocks. Because recent growth is negative, the PEG ratio is essentially non-applicable right now, stripping away a key valuation metric Lynch relies on. It also fails the low debt test, but the biggest red flag, the inventory test. Lynch always checked if inventory growth was outpacing sales. For PBH, inventories rose from $147 million up to $163 million, while actual sales shrank by 4%. Building up unsold goods while revenues drop, that is exactly what Lynch warned investors to avoid.
Section 5. The final verdict. Synthesizing the data.
We've crunched the numbers, we've channeled the legends, and honestly, we are left with a massive dilemma. The quantitative models, all 5 of them, pass with flying colors, screaming that the stock is a deeply discounted buy. But both of our legendary qualitative checklists get snagged. Buffett loves the moat but hates the $1 billion in debt. Lynch loves the boring, essential product line, but he balks at the high debt and the rising inventory against falling sales, which, again, was caused by this Clear Eyes supply chain woes.
So, synthesizing all of this together, the final verdict is neutral, leaning cautiously bullish. The stock is undeniably cheap. I mean, finding a double-digit free cash flow yield and a PE near 10 for a consumer staple company is extremely rare. However, this is really only for investors willing to be incredibly patient. You have to be willing to ride out the Clear Eyes supply chain fixes, wait for their new Pillar 5 acquisition to actually improve production output, and just endure the noise of those shareholder lawsuit headlines.
So I'll leave you with this question to ponder as we wrap up this explainer. Based on the raw data and these legendary frameworks, is prestige consumer healthcare a deeply discounted staple that you should buy and hold forever? Or is that billion-dollar debt pile the ultimate value trap just waiting to spring? It all comes down to your timeline and your tolerance for a messy balance sheet. Thanks for running the gauntlet with me today, and as always, keep asking the hard questions.